Our speaker for today is Matt Weaver. Matt has served in the investment and risk management industry since 2003. He has been an advisor for Fremont Bank Financial Services since October 2015. Matt holds a Bachelor of Science degree from Belhaven University in Business Administration. He has taught investment and risk management at the graduate level for the University of San Francisco. Matt is a chartered financial analyst, a CFA holding Series 7 and Series 63 licenses. Matt and his wife and two boys live in the East Bay. He's an active member of his community and the investment community in the Bay Area. With his free time, Matt enjoys coaching youth sports, running, cycling, golf, outdoor recreation, spending time with his growing family. So please welcome Matt Weaver.
Mm-hmm.
Hey, great. Thank you, Paul, for that introduction. And it's good to be with everybody on this beautiful President's Day. I'm outdoors right now. It's wonderful and enjoying the holiday. But I'm glad to be with you. This is the fourth time that I've presented to a SIRS group, and the second time I've done it virtually via Zoom. And I have to say, you guys got this down pretty well. So, but good to also maybe be with you in person in the near future. I'm glad to hear that you're planning to do that in March. So thank you again, Paul, for the introduction. I am a financial advisor at Fremont Bank Financial Services. And what my team does is within wealth management is we manage 1.4 billion in assets. My specific team unit manages about 250 million. I personally live in Livermore and have offices in Danville and all across Fremont and all across the Bay Area. So happy to be with you here today. What I had in mind is to share a presentation that I've done before. In fact, I did it a couple of months ago, and it's our outlook for 2022. So we'll share some thoughts about the market, the economy, stocks, bonds, maybe answer a question on cryptocurrency. You know, we'll see where it takes us. You'll notice that we're off already. It's President's Day, February 21st, and our forecast for 22 isn't perfect, but a lot of it's still in line. So I'm going to go ahead and share my screen, and we'll jump right into it. So let's do that. Okay. Can everybody see my screen?
Yes.
Yes.
Okay, wonderful. Okay. So the theme and the idea of our outlook for 2022 is passing the baton. And just to begin, just to share what that means, what we mean by passing the baton is this recovery starting in May of 2020, once the pandemic hit, has been really good, really one of the fastest recoveries in history after one of the fastest drops in history. And the economic growth has really primarily been driven by stimulus, record stimulus. And so government intervention, Federal Reserve activity, really keeping the economy afloat. And passing the baton is this idea that I think in 2022, it's time to hand it off to small businesses, to individuals. Less government involvement and stimulus is needed. And it's time for small businesses, individuals. I think they're ready to carry the load and take over in terms of economic growth. So that's the idea with handing off the baton, giving the emphasis to individuals to determine the course of the recovery from here on out. So the economy, you know, we had one of the largest drops since the Great Depression back in 2020. And a combination of record stimulus, healthy consumer, a strong, healthy consumer, accommodative Fed, vaccinations, reopening of businesses, all really contributed to a big year we had last year in 2021. So GDP in 2021 was 5%, which more than made up for the 3.4% drop that we had in 2020. Now we've had hiccups along the way, yes. But you know, we've had to start up in a $20 trillion economy that we shut down. And of course, there's going to be hiccups, supply chain backlogs, material and labor shortages, higher prices. But yet still with all of that, the consumer is in good shape. There's a lot of demand. We're seeing that in the result of inflation and higher prices. I heard you talking about higher car prices and the markup on the MSRP. I mean, there's a lot of demand out there. The U.S. consumer is in good shape. So I do believe that we'll continue to see good economic trends into 2022. However, there are certainly going to be some challenges, which we'll talk about. So this was our 2022 economic forecast. This was at the big end of 2021. So this is what we thought we would be looking like for 2022. So various measures of output. And we can look back in the rearview mirror and look at 2021 to see what GDP was like here in the U.S. at 5.5%. Inflation is also shown there at 4.5%. Here in the U.S., the unemployment rate was 5.4%, and the 10-year Treasury we thought was going to end between 1.5 and 1.75. We are off if we look at our projection for inflation, which is in the bottom right-hand corner for 2022. We did believe that inflation would not escalate as much as it has, that it would gradually decline. There are really two kinds of inflation. One is the CPI, which is what everybody's familiar with, the CPI index, and the other one is the PCE inflation, and that's more of a core inflation that strips out a lot of things like oil, gasoline prices, some other very volatile cyclical goods, and so it gets to more of a core reading, and that core reading is not as high as 7%, but it's still escalated. But as you can see, I think we're going to end up being off on our projection for inflation. It's probably not going to be 3.7% by 2022. But I do feel good about unemployment rates remaining low on the 10-year Treasury, staying within the range of 1.75 to 2%, despite the Federal Reserve raising interest rates. So GDP growth, is really the most important thing for the economy. And what is GDP growth? It's really, and I'm going to talk about this in a little bit in a moment. It is, the number of civilians in the workforce here in the U.S. times their productivity. So how many people do we have in the U.S. and how productive are they in producing? And is one of the reasons I'm very optimistic about investing in the U.S. and not investing in developed European and other developed countries or even emerging markets is because they're not experiencing the same demographic benefits that we are here in the U.S., where we have a working age that's growing versus Japan, China, and other countries where the working age population is actually not growing as fast. And at the same time, we're also probably the most innovative and productive country in the world. And so growth in the workforce plus innovation and productivity means good economic growth. And one of the reasons why we would continue to favor investing in the U.S. versus investing in many other places. So I talked a little bit ago about inflation. So this projects those two, shows actually a history, not a projection of inflation. The blue being the CPI inflation index, and then the PCE is the orange line over time. So what we can see here is that we did see a spike in the CPI inflation reading, but it always tends to kind of revert back to the PCE. So while inflation pressures are going to continue in 2022, I do think that they'll start to moderate as supply chain shortages, people go back into the workforce, some of those things subside. We will see inflation coming down a little bit. And of course, what the Federal Reserve is having to do to raise interest rates, this is the reason. If we didn't have this inflation, I don't believe the Federal Reserve would be as hawkish as they are to raise interest rates 3 times or 4 times. They've said 3, but others say maybe 4. And that's really the biggest headwind right now to the stock market is inflation and the need as a result of inflation to raise interest rates. Now, looking at the big picture, what this shows is, I mentioned this earlier, is the demographics. One of the things that's hard to project is innovation and productivity, new ideas, the next great minds, Steve Jobs. What is Apple producing? What technologies will come? And it's hard to project that. We don't know until we're there. But what we can project is demographics. And so, this visualization shows you indexed to about 2020 at 100, and it shows three countries in all of Europe. And what you can see is Japan from the 50s into the 60s, 70s, and 80s was growing at a faster pace than Europe and China and the US. And China was growing fast as well. But then at some point, what we've seen now is a plateau of that. And where the projections are that the US working age population will continue to grow, we see China putting restrictions on birth rates. And not sure why, but Japan's working age population is decreasing as well as Europe's. And so this is really a demographic that gives me some optimism here about what's going on here in the US, being that it's the only advanced country that will see their working age population grow at the end of the century. And this is largely due to immigration, I believe. So while our major competitors are at risk for similar problems to what Japan is facing, we're looking to be in pretty good shape. So I wanted to show you here is the labor market and just the impact to jobs once the pandemic hit. And so obviously we were on a nice straight line with non-farm payrolls increasing every month, and then sharp decrease in April of 2020. But the U.S. has gained 85% of the jobs that were lost. This has been a rapid recovery in comparison to what happened back in 2008. And so this was not a typical recession that we've been out of for a while. We're not in it. It's been a while, but this was not a typical recession. It was more of I believe, a suppression of economic activity due to public health measures. And so just something that we've never ever faced before. But good to see the employment coming back. And there are a lot of jobs out there, and it's just hard to fill them. Is where we're at right now. Now, where's the 15% that were lost? Well, one of the sectors that it should be pretty clear that was hit the worst was the restaurants and the bars. And so what I'm showing you here is just the sector that has not recovered the jobs back that other sectors have recovered. And so in this graph, it shows in the blue line the U.S. 7-day moving average of open seats, open tables at restaurants, and it shows that it's down, it's come back, and we've seen a little bit of a decline here at the end of 2021. What it's also interesting is to see the contrast between different states, Texas and New York, and the differences between how the restaurants are opening up at different paces. The other thing, and none of this is supposed to be a political statement or any kind of political view, just kind of showing some of the interesting facts here about some migration, and part of the challenges in improving the unemployment rate. We've seen this migration of the population to certain states like Texas, Florida, Arizona, North Carolina, and away from other states like Illinois, California, and Chicago. So I think a lot of that has to do with taxes, may have to do with COVID-related opening procedures for policies for reopening the economy. But these different regions of the country are seeing their labor markets recover at different rates, mostly related to the strictness of the pandemic measures that have been put in place. Well, this is very interesting. So we never, during the recession, the drop, we never saw our incomes drop. Personal incomes really just increased. And so the blue line there shows U.S. personal income. And then the dashed line is just kind of the long-term average trend. And so this is just the record stimulus that was pumped into the economy and is really, I believe, a driving factor for inflation. A lot of the rationale for inflation or explanation for inflation is the supply shortages and other things, and those are all true. But I think the primary driver for why we're experiencing inflation is the stimulus, the fact that personal incomes and wages have gone up here in the U.S. And it's less of a result of the supply chains. But this big mismatch between supply and demand is what's causing inflation. Our incomes are up, our wages are up. There's a lot of demand, but there's not enough supply. And so eventually, at some point, this will kind of moderate back to long-term averages. And then what's interesting here is the 10-year Treasury yield. Now we know that it's not just the 10-year Treasury yield; it's the real yield. So yield earned by Treasury bonds, wonderful. You collect a little bit of interest, but the problem is with inflation at say 7%, your real yield is more like -5%, -6%. You're losing. And so we've never seen real yields this low before. It's a record low. And not even during the darkest days of the pandemic. So this is largely due to the very hot inflation readings. And I do believe rates have to normalize to some degree before we can see this improve. Another interesting thing is the difference between Treasury yields and the stock market's yield is still pretty wide. And so I think this is more of a statement about why I think the stock market is still an attractive place to invest. Because even though the interest rates have come up a little bit in anticipation of the Federal Reserve raising interest rates, the long part of the long section of the yield curve hasn't come up a whole lot. It's come up a little bit. It's the short-term side of the yield curve that's come up. So the yield curve is almost flattening. It's almost, there's talk of it inverting, but I think it's going to just kind of look a little flatter. So the yield on the 10-year relative to the yield on the S&P 500 is still pretty wide. So even though stock prices have come down, it's actually made their earnings yield look better. You compare what you can get on the S&P 500 in yield compared to the 10-year Treasury, and it's a wide spread. And so it's very attractive, therefore, to be in the stock market if you're receiving dividends, if you're in high dividend paying stocks, relative to putting your money in book treasuries or even the 10-year Treasury as an index, and really resulting in negative real returns. So what is one of the most compelling reasons why I'm optimistic about the stock market is not just personal incomes. The U.S. consumer is in good health, lowest debt, highest wages, strong balance sheets, lots of pent up demand. It's not just those things, but the main reason, it's corporate profits. I mean, we've seen corporate profitability at record highs. And even last year, 2021, whatever the projection was for corporate earnings, that corporations beat it by 25%. Now, I know it was 2021, is right after, a tough year in 2020, but corporations still outperformed the expectation for earnings. And I think that may not continue this year. I think this is kind of a year of more moderation. We're not going to see enormous growth, but I think it's going to be good. And even so far in the first quarter of 2022, we've seen pretty good corporate earnings results, which makes me feel pretty good about owning companies like Apple and Chevron and Johnson & Johnson, high dividend paying stocks, or really anybody, even in the tech sector. That's if the stock's earning a profit and earnings are growing, I feel good about investing there. In fact, and if their stock price drops 15% because the whole market does, well, it becomes a value to me. It becomes a buying opportunity is how I look at it. So this is fundamentally very positive for the markets. Though we don't expect this pace of growth to continue indefinitely. But we do expect corporate profits to be high into even 2022. So this is the tracker that I look at to kind of stay on top of how are we doing with regard to COVID and the variants and recovering from what the recession that started in 2020 in May of 2020. So these are some of the economic readings that we look at to see, okay, how are we doing? And I'm not going to go through each one of these individually. But we look at initial jobless claims, and yes, we look at continuing jobless claims. If it's in green, if you look at the percentage change to 2019, so green's good, red's bad. So yeah, there's still a lot of areas for improvement here, from current levels today to where we were in 2019. But there's some good stuff here too, and it's improved. And if we look at the change month over month, there's a lot of good things happening. So in terms of getting the economy back on track after shutting it down and suppressing it, this has looked a lot better now than it did a year ago or even a year and a half ago. So these are the metrics that we follow to see how we're doing in terms of getting out of the suppression. So stock market. Investing in the stock market, gosh, I wish it felt like watching paint dry, but it doesn't. It feels more like being in Vegas right now. It feels like, it's really volatile. It's really risky. At least that's how we feel about it. But we do have prospects for above average economic growth and earnings gains. And for stock investors, we think that will result in a good year. What you'll see a little bit later in one of my slides is that we projected at the beginning of the year about 9% return on the stock market for 2022, 9%, S&P 500. Well, we're not moving that direction, so we've dropped, and now it's more like we're thinking 15, 16%, because at lower levels, we haven't changed our long-term forecast. So we're down. We think we'll still get up, 15 to 16% by year end. So while the pandemic is not completely behind us, and there are a lot of risks to watch, inflation, Ukraine and Russia, rising interest rates, but stocks have historically done well where we're at right now in the economic cycle, which is a mid-economic cycle. We're not in the expansion phase. We're not in the contraction phase. We're somewhere in the middle, and stocks usually do well during that period of time. So we believe we've started or already in the middle of an economic cycle with at least a few more years left. And historically, if this is true, then we believe that there's a good chance for another year or two of good stock returns. So what's shown here is the S&P fair value. So right now, I believe we're at 4,300 on the S&P 500, around 4,300. We're still holding firm to the S&P 500 at 5,000 to 5,100, which was about 8-9%, and now it's more like around 15%. But mainly driven by earnings. I mean, we believe earnings are going to grow at around 8% a year, and so as a result, we think that the stock prices should as well. Now, what's the catch here? Valuations. So one of the metrics that you look at is the price to earnings ratio. How much are you paying for a stock's earnings? And right now it's around 20, 21. Well, it's probably come down since the market's dropped, but it was around a 21 PE on the S&P 500. The NASDAQ, for example, has a price to earnings of 36. So you pay a lot more for a growth stock's earnings than you do for companies, the S&P 500, and the Dow Jones might be even lower price to earnings multiples. So what allows you to be willing to pay more for a stock's earnings is, do you have any other choices? You have bonds to put your money in, earning zero, or the bank to earn zero, degraded by inflation. You don't have a lot of choices. So this accommodative, you have real estate and there's other asset classes, but accommodative Fed has allowed for the price to earnings ratios to come up. Now, what the price to earnings ratios will do when interest rates go up is they'll come down. So when the Fed's raising interest rates, all of a sudden now bonds become more of an attractive asset class. The cash flows of growth stocks are going to be discounted now at a higher interest rate with higher rates. And so the cash flows are worth less. So the price to earnings comes down. So the point of all this is one of the things that are happening right now is multiple contraction, not expansion. So the price to earnings ratios are not going up, they're going down. And so if corporate profits or earnings don't grow, if they stay flat, I believe the stock market will be down. It'll finish the year lower. So we're not going to get any growth out of PE expansion because I think it's going to contract. So the only reason we're going to get growth is from earnings growth. And that's really what the focus is on earnings growth fundamentally. And the projection, again, is for that to be about 8% growth on earnings. So what could be a risk here for corporate profitability? It might be, the biggest one might be wages, profit margins for corporations being squeezed because of higher wages. That's possibly a concern. With inflation comes higher wages, but other than that, I think earnings should be good for the year. That's our belief. So we're in the mid cycle of a recovery. What we're showing here is the S&P 500 for different years, going all the way back to, I'm not sure how far it goes back, 1960. So you can see the years where we were up greater than 25% in the dark blue, the lighter blue, 15 to 25%, kind of the turquoise blue, 5 to 15, and then the negative years in yellow, orange, and another kind of orange. The mid-cycle years, where we believe we're at right now, not the expansion, not the contraction, those are in bold or are highlighted. So for the most part, they are, lean towards the positive side, greater than 5%, but there's a few of them that are, in the yellow that are flat. So this partly gives us, some optimism that in a mid-cycle, more likely the stock market is positive during that year with an average gain of 11.5%. Or as it says on there on the heading, the S&P 500 index rose 80% of the time during mid-cycle years with an average of 11.5%. So that's where we think we are right now in terms of the economic and market cycle. And this graph shows is the S&P 500 index and the impact of the stock market relative to rising interest rates. So the Fed, which we expect to start raising interest rates in 2022, can also help us gauge the cycle, because a central bank typically begins to raise interest rates when the economy is exhibiting mid-cycle characteristics, which we are, and so that's why they're raising rates. And even the Fed has said that's where we're at in a mid-cycle. So historically, stocks have done very well during a period of time when interest rates are rising. I know it's not at first. There's been a shock. They're raising interest rates. Stocks have come down. That's what's happening now. But usually when they're raising interest rates, it means that there's economic growth, there's demand, there's something positive happening. I don't believe the Fed will raise interest rates 4 or 5 times if the stock market is falling and if the economy is slowing down. They're not going to overdo it. And I guess that's probably the biggest risk, is that the Federal Reserve overdoes the tightening and raises rates too high. So during rising interest rate environments, all of those time periods are rising interest rate environments. The S&P 500 has trended upwards, done well in a rising interest rate environment. And so there has been a surge in earnings. So what we're showing here is similar to what was seen before, just corporate earnings growth going back to 2019. It doesn't look like we even, I mean, 2020, we skipped, we gave up a little bit, we dropped, but we've picked right up. And earnings have continued to grow. And again, so I'm repeating this kind of redundant with this slide, but there is an emphasis that the economy will, the stock market will grow based on earnings strength.
Hey, Matt, we got a number of questions. I'm wondering if we can go over the questions. Do you want me to read them to you, or do you have access to that and could read them yourself?
Let me see if I can get into the chat box. So,
wow, got lots.
So this is the last slide on the stock market. So I'll just hold it here for now, and we can check questions. But this, and I'll check the questions. But this graph shows our forecast. This is actually done by First Trust, one of my partners. But it shows the accuracy of their forecast and the dots relative to how it actually ended up in the line. So pretty accurate with their forecasting of the Dow and the S&P 500. And as you can see, their forecast is for the Dow and the S&P 500 to be up by the end of the year as well. So with that, let me check the questions here in the chat box. Paul, do you want me to just go through and read them?
You can go through them, or I can read them to you. Either way.
Okay.
Why don't you just go through them if you can pick them up?
Yep. Okay. All right. So are retirees eligible for Roth IRAs? If so, how does one go about creating one? Also, can you explain black door Roth IRAs? So if you don't have earned income, you can't contribute to a Roth IRA. So you have to have earned income, then we can contribute to a Roth. If you're retired, then likely you don't have earned income, and probably the answer is no. A backdoor Roth IRA is one in which you open up a traditional IRA, or you have a traditional IRA and you convert it to Roth. So you have a traditional IRA, you convert. So you may be ineligible to use a Roth IRA for whatever reason, maybe good income, and you're already contributing in other places, but you can use a traditional IRA, contribute there, and then convert it to a Roth. Which is often a good strategy if you find yourself in a period or a year where you're in a low tax bracket temporarily. So next question, what do you think of cryptocurrencies? Do you include them in investment portfolios? That's a really good question. Probably gosh, I get this one a lot. Obviously, it's one of the biggest questions I get. So here's how I feel about cryptocurrencies. I don't fully understand them because there's nothing tangible with the cryptocurrency. There's not a building or a physical metal like gold. There's no cash flows. It doesn't pay you anything. You can't pay taxes in cryptocurrency. You can't pay the IRS. Yeah, you can buy some things on some exchanges. You can buy goods and services. Now it's growing, but it's really just a storage of value. And how do you evaluate whether it's a good investment? I haven't had anybody explain to me, this is how I analyze and evaluate cryptocurrency and determine its fair market value. No, it's almost impossible. Well, I just haven't figured it out. It might be possible, but so for those reasons, I'm a little bit apprehensive, but I also believe that it's going to be part of the future. And because it's being adopted, it'll probably become regulated. It's not going away. And once the regulations are in place and it's a regulated asset class, they're not all going to survive. There's a lot of cryptocurrencies out there, but it may only be Dogecoin, Ethereum, and Bitcoin that survive once the regulations come in place. So got to be very careful. I feel like they play a role in portfolios? Yes, in some cases. I think whatever amount of money you would allocate to cryptocurrency needs to be an amount that you'd be willing to lose. All of it, maybe. That you would be okay if you lost it all. Not that I think it will go to zero, but it's that volatile. So, if that's 5% of your liquid resources or portfolio, I feel okay with that. Depending on your circumstances, situation, I think it makes sense. I think it's an exciting area for growth within your portfolio. It's the highest risk, but yes, I do think it, in some cases, makes sense to allocate to cryptocurrency. It's down 38% right now. So if there was ever a time, yes. And we do help clients with investing in cryptocurrencies. I use index funds, though. I don't get into Bitcoin, Dogecoin, Ethereum, and all the other little ones I don't know. Instead, we use diversified index funds that have a basket of cryptocurrencies. So it's a little safer way to invest there. But right now, with them down 38%, we're certainly allocating money in that direction for those where it makes sense. So hopefully that helped answer a little bit of that question. Yeah. What do you think is the impact of power policies? So I guess power policies, I'm not familiar with the term. So if maybe you could explain what you mean by power policies, and I'll try to answer that question.
Fred,
Matt, just the question of energy and what's going on in energy development in the United States versus other countries and so forth.
Okay, yeah. So energy, yeah. Well, I do believe that I do believe that dominating the energy sector here in the U.S. would be good. Having a supply of oil and gas here in the U.S. and not being reliant on other countries, I think is a good thing. But that's one, and I think that's gone away. Number two, though, the clean energy trend is there, and we're investors in clean energy. So we invest in solar, wind and power, and lithium batteries. We have specific investments that we put our clients in that are clean energy focused, because we believe that's going to be, an area for growth and innovation in the future. But as far as, the government policies on what decisions are made related to energy, oil and gas, I don't know if I want to get into that too much politically. But I think that we need to be our own suppliers of energy and not be reliant on other countries.
Okay.
Fred, I mean, is there anything more to that you're curious to know about, or is that?
No, I think that's kind of the flavor, Matt, that I was looking for. I know that there's political aspects to the whole energy question, but energy is what drives a lot of things. So that's why I was interested.
Yeah. Well, I can say as an investor, professional investor, we are investing in both right now, both clean energies and oil. And here's why. Clean energy, whether it's wind, solar, lithium batteries, all that, because we believe that's going to be the future. But we're also investing in oil right now and gas because of what's happening in Ukraine and Russia. And there's risk that if that invasion happens, the price of oil goes up and energy stocks do well. And by the way, at the same time, oil and energy pays nice dividends of 5 to 9%. And so right now we're actually investing in both. What's beautiful about how we manage money, though, is it's fully customizable. So if there's certain socially responsible constraints, we can overweight something or completely remove another thing. It's a completely customizable portfolio. But that's how we're investing right now. It's kind of almost it's like a barbell strategy on the energy spectrum. Okay, so next question. How valid is the core inflation rate if it eliminates the items of most cost to those with the lowest incomes? Yeah, I mean, that's a good question. So that's why they're both monitored. The marginal cost of filling up your car with gasoline is greater for those with less incomes than somebody with higher income. And so it's not eliminated, which is why we have to look at both. And what the trend that I was pointing out earlier is that the volatile inflation rate always tends to kind of revert back to the core PCE inflation. But I mean, they're both monitored, both equally important, and the CPI is the one that's painful. It's more painful for those with fixed budgets, lower incomes, to have the extra burden of inflation that affects them most. So, why are our demographics different? So, as you're referring to the projection on of the different countries' demographics.
Yes.
Well, I think one is in China. There's certain things that they're doing to limit now. They've been limiting the number of births, so that birth rates declined in China, and I'm not sure why in Europe or in Japan the birth rates had declined. Again, this isn't birth rates today, because this was birth rates 15, 20 years ago were declining. So the working age population is not growing as fast. And I don't know, forgive me, I don't know all the particulars into what's driving that. But the main point of that is that the economic projections are that the working age population is growing more in the US, and we happen to also be the most productive and innovative.
Okay, thanks.
So how do you expect just-in-time supply chain schemes to change in reaction to issues encountered during and after the pandemic? Wow, that's a pretty specific question. So just-in-time supply chain, I'm familiar with it, but I don't know it and studied it well enough to really give you a good answer there. So something I'll have to research myself and get back to you on.
Okay.
I mean, I do hope that there'll be enhancements and improvements in the supply chain process, so that the next time, this may not be the last time this happens, the next time, we are much more nimble in terms of being able to shut down and pick right back up. But do I know what the particulars of that are? No.
Okay.
Joel, why does the personal income increase include the large unemployment grants? Yes, it does. That's part of it. So the checks that were given were certainly part of the infusion of cash into of money into the system that was considered part of personal incomes.
Okay.
Is there expectation of economy by LPL after the invasion of Russia into Ukraine, and any estimate of recovery of possible recession? Well, LPL hasn't specifically, or I haven't specifically come to a conclusion whether this is happening or not. It's just, we hear the same thing you are, and it's day by day, and imminent invasion happening, troops adding, troops subtracting. No, just kidding, they're actually adding. So I mean, it looks likely there will be some invasion, and but we'll see. If it were to happen, I believe it'd be a shock to the market. I think the stock market might drop on bad news. Why? Because the stock market always drops on bad news. So not always, but often it does. And in this case, it would drop. Or price of oil would shoot up. Inflation probably would go up a little higher. Why? Because of oil, price of gas. And we'd find ourselves probably not in a war. And maybe I'd take the advantage of that as a buying opportunity for someone who's been sitting in cash or in bonds or in something else, to buy stocks and buy into the stock market on the drop. And it would be a shock, but then in the long run, it would dissipate. We're not going to war, I don't believe. We'll be involved from a distance. And will this affect corporate earnings? No. And what did I think the number one driver for the stock market is? Corporate profitability. Apple's going to still sell you an iPhone. You're still going to go buy your new car at the dealership. You're still going to go out to dinner and spend money in different ways. And chips are going to still be in demand, and Nvidia is going to be selling them like crazy, regardless of what happens between Russia and Ukraine. But the market will drop on the news, and then we'll be able to use it to our advantage when we buy into it.
Matt, I've seen people that in the crisis, whether it's 2008, whether it's COVID, completely pull everything out of the market. I mean, do you adjust what you're doing? I'm assuming you don't pull out of the market, but Just curious what you think.
Well, so in general, anytime you just do anything dramatic, it usually doesn't go well. You know, if you pull everything out, that usually doesn't go well. If you put everything in, it doesn't go well. So if you're the type that if you're looking at your investments, or as I'm managing 250 million, the way I think about it is, if things aren't going well and it seems scary or we're concerned, we'll gradually step out of the market. But the moment you just do something dramatic and say, okay, I'm selling all, going to cash or to bonds, you know, your luck would be that the market goes up. And I do believe there's risk in both directions. Risk to the downside, which everybody knows, but risk to the upside is real. If you pull out into cash and the market goes up, well, then your opportunity cost is there. You have to go back in and buy the same stocks at 10% higher prices than what you got into it. So I think gradual shifts, averaging out of the market, averaging into the market, always makes sense.
Okay. One last question. It said, let's see, if you attempted to blame inflation on one factor, what would it be? Is there one factor that is driving inflation at the moment?
Yeah, I think it's income, personal wages, income, which has come from infusion of monetary policy and fiscal policy that has boosted the economy over the last year. Now, secondarily to that would be the supply chain shortages. But I think, as I showed in the earlier slide, incomes never went down.
Okay. Thank you very much, Matt. It's been really interesting, really enlightening. I appreciate your talking to us today.
Yeah, well, thank you for having me.
Fred, I'll turn it back over to you.